Getting a loan when you have bad credit can feel like an uphill battle. It's a common situation for many people, and it presents unique challenges. Lenders view borrowers with low credit scores as higher risk. This perceived risk means lenders are less confident you will repay the money borrowed. They see a history that suggests potential difficulty in managing debt. This makes them hesitant to lend to you. Because of this higher risk, lenders often compensate by charging more. You can expect significantly higher interest rates compared to someone with good credit. There will likely be more fees involved as well. Sometimes, to offset the risk, lenders require security for the loan. This might mean putting up collateral, like a car or savings account. Alternatively, they might require a cosigner with a strong credit history. Navigating this process successfully requires careful planning and preparation. Understanding the obstacles is the first step. Being prepared helps you find the best possible options available to you. Your credit reports are the foundation of your financial reputation. You are entitled to free copies from the three major bureaus, Equifax, Experian, and TransUnion. Get a report from each one. Reviewing these reports thoroughly is critical. Look for any accounts you don't recognize or payment histories that seem incorrect. Even small errors can negatively impact your score. If you find mistakes, dispute them immediately with the credit bureau. Provide documentation to support your claim. Correcting errors can potentially improve your credit score over time. Knowing your actual credit score is essential before applying for a loan. Many services offer free credit score checks. This number is a snapshot of your creditworthiness at a specific point. Your credit score heavily influences whether you get approved for a loan. It also determines the interest rate and terms you will be offered. Understanding your score helps manage your expectations. A low score doesn't mean no options, but it does narrow them. It prepares you for the types of loans and rates you are likely to encounter. This knowledge is power in the loan application process. Not all loans are created equal, especially for those with bad credit. It's important to research loan products specifically designed for this situation. These loans often have different structures and requirements. Personal installment loans are one common type. You borrow a fixed amount and repay it over a set period with regular payments. Approval criteria can vary widely among lenders. Secured loans are another option worth exploring. These loans require you to pledge an asset as collateral. This could be a vehicle, savings account, or even real estate equity. Credit builder loans are specifically designed to help you establish or improve credit. You make payments into a savings account, and the funds are released to you once the loan term ends. It's a way to prove responsible repayment. Understanding secured loans is key if you have assets. By providing collateral, you reduce the lender's risk significantly. This makes them more willing to approve your application. The collateral acts as security for the lender. If you fail to repay the loan, they have the right to take possession of the asset. This is why secured loans are less risky for the lender. Because the lender's risk is lower, secured loans often come with better terms. You might qualify for a lower interest rate than with an unsecured loan. Approval rates are also typically higher. Finding a cosigner with good credit is a powerful strategy. A cosigner agrees to take responsibility for the loan if you cannot make payments. Their good credit history helps your application. Having a cosigner significantly increases your chances of loan approval. Lenders see the cosigner's strong credit as a backup guarantee. This reduces their risk considerably. A cosigner's good credit may also help you secure a lower interest rate. The rate offered is often based on the stronger credit profile between you and the cosigner. Choose someone you trust deeply. Improving your credit score is always beneficial, even if you need a loan now. While it takes time, consistent positive actions help. Paying down existing credit card balances is impactful. Making all your debt payments on time, every time, is crucial. Payment history is the biggest factor in your credit score. Even one late payment can cause a significant drop. Reducing your credit utilization ratio also helps. This is the amount of credit you're using compared to your total available credit. Keeping it below 30% is generally recommended for better scores. Even if you get a loan with bad credit, continue working on improving your score. Responsible repayment of the new loan will contribute positively. This opens up better financial opportunities in the future. When you have bad credit, researching lenders is more important than ever. Look for financial institutions that specialize in working with borrowers in your situation. Not all lenders are the same. Consider different types of lenders. Online lenders often have streamlined processes and may be more flexible. Credit unions and community banks can sometimes offer more personalized service and understanding. Compare potential lenders based on several factors. Look at their eligibility requirements for bad credit borrowers. Check their stated interest rate ranges and any associated fees. Once you find potential lenders, compare specific loan offers. If you pre-qualify, you can see potential terms without a hard credit check. Compare the annual percentage rate, APR, which includes interest and fees. Look at the loan term, which is how long you have to repay the loan. Consider the monthly payment amount and ensure it fits comfortably within your budget. Factor in any origination fees or late payment penalties. Being prepared with documentation speeds up the application. Lenders will need proof of your identity, like a driver's license or passport. They will also require income verification. Gather recent pay stubs, tax returns, or bank statements showing regular income. You might also need to provide details about your assets and existing debts. Having these ready prevents delays. Apply strategically to minimize the impact on your credit score. Each time you apply for credit, a hard inquiry is typically made. Multiple hard inquiries in a short period can slightly lower your score. Focus on applying to only one or two lenders you have thoroughly researched and are most likely to approve you. Avoid applying to many places at once. Follow each lender's specific application instructions precisely. Before you sign any loan agreement, read it very carefully. Understand every single detail of the contract. This document outlines your obligations and the lender's terms. Pay close attention to the interest rate, the full repayment schedule, and all fees. Understand the consequences of missing a payment or defaulting on the loan. Don't hesitate to ask questions about anything unclear. Be extremely cautious of predatory lenders. These lenders often target vulnerable borrowers with bad credit. They may guarantee approval without checking your credit history. Warning signs include demanding upfront fees before approving the loan. Extremely high interest rates, like those found with many payday loans, are also a red flag. These loans can trap you in a cycle of debt that is hard to escape. Once you have the loan, your primary focus must be on making every payment on time. This is the single most important action you can take. Set up reminders or automatic payments if possible. Making timely payments avoids late fees and potential penalties. More importantly, it prevents defaulting on the loan. Defaulting has severe negative consequences for your credit and financial future. Responsible repayment of your loan is a powerful tool for rebuilding credit. Each on-time payment reported to the credit bureaus helps improve your payment history. This is a key factor in your credit score calculation. As your payment history improves, your credit score will gradually increase. This demonstrates to future lenders that you can manage credit responsibly. It opens doors to better financial products later. Consider alternatives if traditional loans seem too difficult or costly. Borrowing from trusted friends or family might be an option, but ensure clear terms are agreed upon to protect relationships. Nonprofit credit counseling agencies can offer assistance. They may help you create a budget or explore debt management plans. These plans consolidate debts and can sometimes negotiate lower interest rates. Check if your employer offers any assistance programs. Some companies provide emergency funds or financial wellness resources. These could be short-term solutions. Utilizing credit builder products can be a strategic move. Some institutions offer small loans specifically designed to help you build credit history. Secured credit cards serve a similar purpose. With a secured credit card, you provide a deposit that becomes your credit limit. Using the card responsibly and paying the balance on time helps build positive credit history. It's a stepping stone. Avoid high-cost payday loans at all costs. While they offer quick cash, their fees and APRs are exorbitant. They are designed for short-term use but often lead to borrowers repeatedly renewing the loan, creating a debt trap. Getting a loan with bad credit should be viewed as a step towards better financial health. It's an opportunity to prove your ability to manage debt responsibly. Use it as a tool for improvement. Focus on the long-term goal of improving your credit score. Responsible management of this loan will contribute significantly. A better credit score will lead to more favorable terms on future loans and credit products. By understanding the challenges, assessing your situation, exploring options, applying carefully, and managing the loan responsibly, you can navigate getting a loan with bad credit and work towards a stronger financial future.